Hello, everyone. Welcome to GreenSky's podcast. This is our short mini series on conversations around term sheet. We have esteemed guests with legal background. We have Marc Shewchun from Faskin. We have James Brink, and we have Mike List, all with legal background. Mike is not practicing anymore, but Mark and James are actively practicing. Why don't you start with Mark? Mark, give us a quick background about yourself, and then we can dive deep into the term sheet discussion.
Yeah, hi, thank you. Thanks, Moien, Mike, and James for opportunity to participate in this. My name's Mark, as you said. I am a partner at Faskin in our emerging technology practice in Toronto. Faskin is one of Canada's largest law firms with 950 lawyers, and in our practice group here, it's all emerging companies. I have a long history background in law and business over about 20 years, worked as a lawyer in private practice and also as a general counsel and even in operations in various companies and startups. So I have an interesting career background. Really like working with early stage founders. That's my strength. So thank you.
Great, and James, to you.
Sure. Yep. So my name is James Brink. I'm a partner with Ormston List Frawley. I've been with the firm for about 15 years. We are a corporate and securities boutique. We work mainly with small to medium-sized enterprises. And as well, in addition to my role as partner with Ormston List Frawley, I am a compliance officer for GreenSky Capital. So I do get a lot of the investor side and the investor perspective, as well as the perspective of the entrepreneurs that we work with, who are either forming companies, financing companies, trying to grow them, or trying to think about how am I going to exit, how am I going to restructure and potentially pass this company on to the next generation. It's the full gamut.
Great, and Mike.
Mike List. I am a founder and managing director of GreenSky Ventures. We are raising our sixth fund right now, so we are been deploying capital as a seed and Series A stage primarily investor in the Canadian marketplace for almost a decade. I'm a multiple exit entrepreneur and a recovering lawyer, so I've sat in most of the seats at any deal table that you would find yourself at. But I'll be speaking kind of today from the perspective of a venture investor.
Great, and so in our previous episode, we just had an introduction about term sheet, what it is, what it does, and specifically dive deep into the economics terms, specifically what really constitutes valuation, what are some of the terms that goes into those economic terms. What we want to discuss in this episode is mainly shareholder rights. So we very high level in the previous episode discussed what are shareholder rights. But I guess here in this episode, we want to dive deeper. We want to kind of go through the terms one by one, help entrepreneurs really understand what goes into these terms. And so I guess I start with Mark. Mark, one of the main terms that we have in the shareholder rights is the liquidity preference and liquidation preferences. So why don't we start with that? Maybe you can just give us a high level description, and then we can dive deeper into some examples.
Yeah, happy to do that, and would love to have a discussion with Mike and James on it. I think we touched on it in the previous episode just a little bit, but in short, the liquidation preference is typically the amount of money that's been contributed by your investors in a priced round, and it's called a preference because that amount of money is going to be in an exit paid back before any return is made to the common shareholders. So it's considered to be the investor's preferred return in a downside scenario. Do we want to do some examples, or what do you think?
That would be really helpful. Yeah.
Yeah. So let's maybe take a seed round. Seed equity rounds tend to be where most entrepreneurs would be first encountering preferred shares. Let's say you did like a $5 million capital raise on a, I don't know, let's say $10 million pre-money 5 million post, that's maybe a little bit aggressive in terms of capital, but just to use some round numbers. So you've taken $5 million from your investors. You've given up. We talked about last episode 5 on 15, so about a third of your company is now owned by investors. That $5 million preference is there if you've sold your company for $5 million. That money is going to go back to the investors and none of the common shareholders, which means that the founders, the employees are not going to get a return on an exit like that. Obviously, that's not what people are hoping for and expecting. If you had an exit, if you sold the company for $10 million, then, in that case, there is usually going to be obviously something that you're now above the preference. So there is going to be a return to the common shareholders. And we can talk a bit more too, I suppose, about the different types of preferred shares as well. But, just from a general, high level standpoint, you kind of got to clear that $5 million before there's going to be returned back to the common shareholders.
Yeah, I would add to that by describing there's two main ways that kind of preferred share rights are categorized. One is by virtue of the multiple. So a 1x preferred basically is a 100% coverage of your money. A 2x preferred would be 200. So in Marc's hypothetical, I'd like to know what the company is. It's a young company raising 5 million at a post of 15, hopefully building a plant or something. But in any event, let's assume that company gets sold for 15. If I have a 2x preference, it means I get my 5 million times 2 out. I get 10 out and only 5 is left. Or in Marc's original example, if they only sold for 10, that entire 10, because I have 2x coverage, comes to the investor. So what we see most typically and what GreenSky often asks for is only a 1x. So we're just looking to get our money back in priority to the current investors if there were to be some form of a less than ideal exit. So that's kind of the multiple. The other piece is participating versus non-participating. And maybe, James, I'll throw that over to you to kind of walk through what that means.
Sure. So participating essentially just means that you get your liquidation preference and then you participate with the commons in the remaining proceeds. So in Marc's example, you'd get your $5 million back, and then of the remaining, you would share pro rata with all of the shareholders. Non-participating means that you can elect to get either your liquidation preference back, or you convert your preferred shares and you participate on an as converted basis. You can also have a capped participation where you get your liquidation preference and you share with the commons until you've achieved X return. Typically, there is still the option to convert to commons and just enjoy your pro rata stake along with everybody else in that scenario. But yeah, the difference is really whether or not so on the non-participating side, which I think is probably the most common, it's certainly the most common way that GreenSky structures its term sheets. The investor essentially chooses whether to get their money back, so exercise that liquidation preference, or they convert and they share pro rata with the common shareholders and whatever the proceeds are. Obviously, there's a bit of a spreadsheet exercise on an exit to determine what the best avenue is for the investor, but that's the basic principle.
Yeah, so we would look at GreenSky, to James's point, does a 1x non-participating. And what that means is a fancy way of saying all we're really asking for in the event of an exit that is less than ideal is just to get our original investment back. The reason why you would sometimes look for a 2x or a participating preference would be to try to, again, balance the risk. So let's assume, in Marc's example, I made my first investment of $5 million on a $10 million pre, so I have a $15 million post with a 1x preference. The company doesn't execute the way we'd hoped, but we all kind of think maybe there's a chance we can save this thing if we, GreenSky, were to bump up and throw another $2 million in. They need to do, they went over budget, and they need to finish building their hypothetical plant or whatever. Because the risk is so much higher at this point, it is in those types of situations where GreenSky might look and say, well, in this case, we're looking for a 2x or even 2x participating. as a way to kind of not play with the price adjustment on a value perspective, but to build in more downside protection because we're looking at a situation in which the likelihood of success perhaps is not quite as high as it was when we made our first investment.
Great. And so, Marc, I guess what we're really hearing is that 1x multiple, non-participating as standard is really the common terms. What are some of the, I guess, mistakes, red flags that you've seen a startup should care about when it comes to that liquidation preference? What is a no-go? What do you advise the startups to care about?
I mean, I think, there are deal studies on this. There, you can go see statistics. Definitely, like a 1x non-participating preferred is by far the de facto standard. It isn't always, and like Mike said, there are times when that is not the particular deal term that's being negotiated. But I think it's important for founders to understand these, to look at these deal studies, to talk to their advisors, to make sure that what they're getting is a market deal. And market may change from time to time. And if they're not getting a market deal, understand what the risks might be to doing that. I will say, not all investors are the same, and you will see situations where investors are advancing a position that's not a market term. And the problem with doing that at an early stage of your development is if you give up, I don't know, on your first round a 2x participating preferred, every investor in the A, the B, the C is going to want the same terms that you just gave up. And, as you put more and more money into the company, there is a point at which you're just going to get buried under a preference, and it's going to be really hard to get out of. I don't see that very often, frankly, but I think it is important for people to educate themselves and make sure they've got advisors that understand where the market terms are.
I guess to add to that, as well as to maybe suggest an additional caveat, not all investors are the same, but also not all companies are the same. So there is some risk in looking at, statistically what the most common deal terms are. There may be something about your company that is especially risky, and means that in order for the investor to justify the investment, there needs to be some non-standard deal terms included, whether that's an additional preference, or maybe it's a warrant, or if you're doing a convertible note, maybe a higher interest rate than normal. But there definitely are industries, and it may have nothing to do with your company. It may just be the industry that you're in that is particularly risky for investment.
And I would finish this topic off by saying that you may be able to tell from our collective comments, this is an incredibly complicated issue. It's just one of many, and one of the many issues that are typically buried in a term sheet. And I'll do a bit of promoting for my friends on the call here, but like not reaching out to a qualified, experienced counsel as early as you can is a huge mistake. And to the point where GreenSky just doesn't do deals anymore directly with entrepreneurs. We will not go through the process of negotiating a term sheet unless we know that there's a counsel on the other side who is competent and has had some experience with a venture deal, in large part because what we found in the past when we had done that and negotiated directly with an entrepreneur is it just doesn't result in a partnership that is as healthy as it could be. You want to have that person have all the advantages and advice to knowingly get into whatever deal you can negotiate. And to not do that, as an entrepreneur, I think is a huge mistake. So I would say if you're listening to this and you're in the midst of raising a seed or a Series A or whatever round, and you don't have somebody yet, call Marc, call James, because people like this can be incredibly helpful as you're looking to raise your first rounds of capital.
Great. So James, I'll take it to you. The kind of the next term after liquidation preference is pro-rata rights. We have regular pro-rata rights. We have super pro-rata rights. What is a pro-rata right? What are the differences between these two? And then Marc can comment on what entrepreneurs should care about.
Yeah, and I think when you're talking about pro-rata rights, another term, and I think this is what you're talking about, would be preemptive rights. Would be another term that is often used for this type of thing. And what it means is that when you decide that you need more money as a company, you'll decide how much money you need. You'll put an offer out, and your existing investors have the ability to purchase either their pro rata share or some extra percentage or multiple of their pro rata share on that new offering of securities. From the investor's standpoint, well, there's two reasons why they would want those rights. One is to maintain their position in the company. So that is probably by far the most important reason, because as new money comes in, if they don't have the ability to participate up to at least their pro rata share, they will see their position in the company diluted over time. The other thing too is, many investors, particularly institutional investors, do see their relationship with the company as a relationship. They want to grow with the company and be part of it over time. They don't. It's Well, obviously everybody is in it to make a profit and to make money for their investors, and in venture capital, in the case of venture capital, to make money for their LPs. There is a strong interest also in helping companies grow, and so to the benefit of everybody that's involved. So they don't want to get shut out of future transactions, because that also impedes their ability to further assist the company over time. So.
And so, Mark, what have you seen? What is a common, I guess, pro rata right, and what are some of the things a startup should care about?
Yeah, I mean, pro rata rights are very customary. Again, I can't think of a deal that doesn't have them in there. I would say to founders, usually the most important consideration is who has those rights. I don't, as a general approach to talking to founders, I don't think everybody should have pro rata rights, and it should really be limited to the people that are actually going to use them. And the problem with giving it to everybody, there's a couple of problems. One, practical problem is when you go do your next round, you have to go get all of those people who have these rights to waive those rights, because no one actually wants to go through the process of giving people notice and waiting to hear back if they're actually going to buy the shares that are being offered. So there's a deal friction problem with giving this to too many people. And obviously, the more people that have it, the more of the offering is potentially reserved for existing holders, versus often what you are trying to do is get new money into the company, and the new money wants to own a certain amount. And if you can't, promise them a certain amount, that can create additional friction. And therefore, again, you're going back to people and trying to get them to waive their rights. So I would always say limit those rights to people that really need them. Usually that means what we call a major investor hurdle, which is a way of deciding who are the investors that have a material stake in the company and should get these rights.
Yeah,
And I mean,
that raises a question,
sorry, go ahead,
and I'd love to get Mark's perspective on this, which is, I find that this question of preemptive rights and who gets them is often a point of friction, particularly at the seed stage, where founders may have gotten legal counsel and they raise money from some friends and family. They have a kind of standard form shareholders agreement that includes preemptive rights. And now you have to have the difficult conversation with, all of your friends and family to say, well, now we have an institutional investor coming in. We don't want to have to go out to all of you guys on future rounds to ask you whether or not you want to participate. So we're just going to take that preemptive right away from you. What's your perspective on this? Do you have any suggestions on managing those conversations?
On situations where the founder's kind of already given it
Correct.
to everybody.
Yes.
Yeah, those can be tricky conversations for sure. I think that, probably the right way to deal with that is you're trying to explain to your friends and family that you're headed into this relationship with a venture investor. There are market norms, and there are a lot of things going on, and what you want to do is set the company up for success, right? You want to make your company investable by a venture investor, and there are certain things that a venture investor is going to want your company to be structured in a certain way for good reason. And so you're going to ask your friends and family, hey, we started here as a friends and family business, and we're going into this venture world. And this is just not, amongst other things that I'm going to ask folks to give up, because we want to be investment ready. We want to attract investment from a venture investor.
Sure. Yeah.
Great.
Okay.
I guess we can move on to the next term, which are really around anti-dilution. And Mike, why don't you take us through the anti-dilution preferences, the full ratchet versus weighted average?
I mean, I don't practice law anymore. You're asking the wrong guy. James just tells me what to do and I do
Sure.
it. But as far as I recall, the anti-dilution rights essentially are intended to protect, in the event that capital is raised at a valuation that's lower than the value at which your round came in, is the simplest way to describe it. And what it basically provides, and there's a whole bunch of ways, it can be very technically complex, but the essential principle is that if, use my example from before, but if I invested at a 2 million at a pre of 8, so I'm at a post of 10, and there's a down round, in some cases, the anti-dilution rights are used to support my value. So what it means is if more capital is raised at a down round, I essentially get a small bump up to kind of compensate me and keep me in the same position that I would have been had I invested at that same down round price. That's the simplest description. But again, I will defer to my much more experienced and wiser colleagues on this issue.
And yeah, James, do you want to talk about maybe the full ratchet one, which is probably more investor friendly, and then Mark, you can talk about the weighted average one, which is the founder friendly.
Yeah. So the full ratchet is pretty rare. I don't think I've seen full ratchet on a deal. I'd say it's probably more than investor friendly to the point where I'd probably describe it as predatory. Because essentially what it means is that if you do a down round, then the conversion rights of the previous round, essentially everything gets repriced to whatever your down round is. And it doesn't matter. So if you raised, so let's say, if to go back to your example where you raised 5 million on a $15 million post, a full ratchet basically means that if you do any kind of down round for less than the price of that round, then the conversion price is automatically revised to that price. And the predatory aspect of this is that if you went out and you're just like, this is a bad time in the company. All we need is, $500K just to get us through the next 6 months or even less. All of a sudden now your conversion price for the $5 million that you got is the same price as the $500,000 that you just raised. So much more common, and what I'd say is standard on these types of transactions, is a weighted average, where you kind of mitigate the impact of that down round. So there still is an advantage to the investor that there is a bit of a repricing of their conversion price, but it's based on how much you raised over what the total number of securities of the company is. So if you do a small round, there's a small adjustment. If you went out and did a huge down round, obviously there would still be huge dilution, and your previous investors would still enjoy a lot of benefit. Well, I'd say a down round is not really to anybody's benefit, but at least they are compensated for that in a way that the founders holding common shares are not. But yeah, the weighted average is definitely the standard. And like I said, I've never seen a full ratchet on a deal. But Marc, you may have seen it. But.
No, I don't think so. Maybe when I was a very young lawyer. Yeah, I would. If you see full ratchet in a term sheet, you should be very alarmed.
Just turn around.
Take off, leave.
Good to know.
Yeah, I agree that the weighted average is the de facto standard, and it's actually quite, like, it makes a lot of sense, and I've certainly seen in recent history here founders doing maybe not down rounds, but flat or just below the previous round. There's some dilution that's coming in from notes, and so you do end up triggering these provisions more often than you might imagine. And with the weighted average calculation, it's not it allows for a deal to happen. It gives the existing investors some adjustment to their equity, which is fair because that's what they bargained for when they put money in at the previous round price. So that happens, but the adjustments are not on a an extension round or a flat round where there's a little bit of adjustment and you're bringing in a little more capital, like you're seeing a lot of clients do, companies do these days. It's not enough that's going to really throw a wrench into making the deal happen. So it's actually it does make a lot of sense.
And I guess the two common terms that we see in shareholder rights are tag along and drag along rights. Mark, I start with you. Can you kind of give us a high level understanding of what these two terms are, where they're used, and what are, let's say, the common ways to practice?
Yeah, tag along, co-sale used to be called piggyback rights
Yeah.
when I was a young lawyer, but somebody decided that was just didn't sound very friendly to
It was
founders.
too
So
fun.
so somebody came
Your
up with
rodeo.
tag along, and then maybe co-sale is kind of the most used term, which doesn't sound scary to a founder. Um, yeah, these are again very typical in every deal. It's giving the investors some protection on a transaction. Again, if we think back to like early stages where the investors are holding 20% and the founders are holding 60 70% of the company, if you founder were gonna, let's say you were just gonna go sell control of your company tomorrow, to not give liquidity to your investors doesn't really seem fair. So the co-sale really is there to ensure that the investors are going to get liquidity when you get liquidity, and that's the primary purpose of them being there. So they're uncontroversial in my mind. I don't think I've seen any issues. Back to what we were talking about earlier, though, you know, not everybody should have co-sale rights. You'd often try and negotiate it so that it is the major investors that have this right. That just makes it a little easier in practice to deal with these rights. Drag along right is kind of not that. It's you sort of change your thinking here. This is not now about creating liquidity for your investors. This is where we want to sell the company, so we've decided we're going to go sell. How can we make that process happen? You can't force shareholders to sell their shares at law. If I'm a shareholder, I own shares, that's my property. What you want to have, though, is you don't want to have a small number of shareholders blocking a sale transaction. If you found a buyer, you want to be able to make that transaction happen. So you want to have what's called a drag along right, which is a right to force shareholders into a sale. So then the issue is who gets to decide when we're going to do that. In early stage deals, I would say usually, and maybe Mike and James have different opinions on this, the balance is usually a sort of double approval. The founders or a majority of the founder shares and a majority of the investor shares have to agree on a transaction. And if those two groups agree that we're going to do a sale transaction, then they can trigger this drag along provision.
I mean, I would say, at the risk of giving up all of our secrets to future entrepreneurs with whom we might be engaged in discussions over a term sheet, the idea that I would ever be in a business where I forced a principal, an operator, to not exit because of some reason, for some reason I thought it wasn't the right time. Like, I've been an entrepreneur many times, and I can't ever see a situation in which you would use these unless you had a way to kind of, you were kind of bent on replacing the man. Like, it just seems very unusual, or unlikely, I should say, that you would ever really use a drag along right to prevent an exit. Having said that, I do think it's something that to Mark's point, that most VCs, certainly most institutional investors, would ask for, and reasonably so. In many ways, it's just another leverage point. From our perspective at GreenSky, we're not necessarily looking to prevent a sale. And again, because of a lot of the liquidity preferences and other rights that are built in, it's likely that we have a certain number of downside protections anyways. But what we typically do in our term sheet, and it's not customary in a CVCA standard document, but we have used this concept since we began investing again almost 10 years ago, is we have a 3x multiple where we as an institutional lead have a unilateral negative control right. And what that essentially means is unless you're coming to us and saying, we're going to do this deal and the exit will provide you 3 times your money, if it's less than that threshold, then we get a negative control right over that. We get essentially the right to say that doesn't seem like the right decision. And if it's over that, then that right drops away, and that's simply a vote that goes to the board and the shareholders as any other one normally would. And the reason that 3x is important is because, and this is obviously a much longer conversation, but VCs, it's a tough business to be in. You end up having some just outright failures where your investment position will go to zero. You need to have across the portfolio a certain type of return to be able to generate for your investors the kind of returns that they're looking for. That 3x over time is we tend to view as kind of the minimum return that we would look for on a company that isn't a huge winner or isn't a total failure. And the idea and the concept from our perspective at least is, why do we hit that? Then we're okay if the founder says, let's go ahead. In practicality, and again, I'm giving away all my secrets here, but in practicality, it's never happened in my 10 years. There's never been a case where we have said no or exercised, our rights to prevent the sale. In my view, preventing an entrepreneur who would otherwise want to exit from doing so is crazy. But it does, again, provide a little bit of leverage, and it quite frankly sets a benchmark for value that we'd look to hit, and we would hope the entrepreneur would be on the same page with us.
Yeah, I guess where I see the drag along come into play is it's less of it's not usually the founders or the major investors that are the problem when you're talking about an exit for the company. It's those small investors, some of whom may be disgruntled. Maybe they're former employees of the company, and they're not going to willingly sign a document. They'll just be a obstructionist for the sake of being obstructionist. So that's really where the drag along right comes into play, because it allows the founders and the major investors to work together and make that sale happen, notwithstanding the fact that there may be a couple of smaller shareholders who are opposed to it. And there's usually some clauses that ameliorate the impact on those smaller shareholders as well. Like they're not asked to make the same kinds of reps and warranties or stand behind indemnities that the major investors or the founders of the company may be. But yeah, I really see the drag along as a way to, manage the disgruntled.
So that's a great segue, because I wanted to raise this topic as well. It's one of the ways in which I think GreenSky is a little bit different than some of our peers is, and I'll throw this to Marc, see if I can start a little more of a robust conversation where we might be on slightly different sides of this issue. But one of the things that we often look for is an advantage on secondary. So we build into our term sheets a first right of refusal over secondaries, and it really goes to the very issue that James is raising. What we found is because we are such early stage investors, we're doing a lot of seed deals, that over the life of our typical investment, it's almost always the case that there's a small early friends and family investor that at some point will want to get out. And one of the ways in which we have been able to kind of concentrate our focus on the more interesting companies in the portfolio is through secondaries. And I've had other counsel push back on this in the past, and I'm curious, really, what's your view on that? I mean, the way that we build it, just so you know, is first right of refusal on a secondary to not just GreenSky, but major investors, which would be anyone in our view with a 5% stake or more, who's part of that round, then to founders, and then to the commons or the company itself more broadly.
Yeah, that's interesting. So you have like the standard CVCA, we talked about that,
That's right.
would have company
Company
first, then investors. So you've inverted that to give you the first kick at the can. I would love to argue with you. I don't have a strong view on that particular point, and I've seen it both ways.
I eventually will be able to pick a fight with you. You're going to keep trying, Mark.
Yeah, I mean, I've had this discussion with people, and I'm curious if any, James, or have thoughts as to why the company has the right of first refusal. And, most people kind of go, well, at least in theory, that gives the company a chance to control ownership ahead of everybody else. So it sort of is like, well, maybe it isn't the best thing for GreenSky to own more of the company. It's better to do something else, and therefore we'll figure it out democratically as a company.
I mean, I would weigh in before James jumps in quickly. I would weigh in response and say simply, again, if you think about as a seed stage investor, the last thing I want, if a secondary is happening between, let's say, a Series A and a B, or even around those times, is to be using corporate assets to basically buy back shares.
Mhm.
That is the worst possible outcome in my view,
Mhm.
almost always for a company. You simply do not want that. Is dead cash, right? If I've invested $2 million a year ago and a secondary comes through, and the terms of the deal will allow the company to kind of repatriate those shares, and they end up spending half of that money on a buyback, that means that their runway is protracted. All sorts of things happen that follow to that I view as being, just from an operator's perspective, very dangerous. So part of the reason is not just to advantage GreenSky, it's to make it very clear. And we in fact put also in our term sheets that none of the funds that go in can be used for share redemptions, for dividends, for any kind of cash outlay that doesn't go to running and growing the business. And so again, from my view, it's not necessarily how do we advantage GreenSky. It's more how do you set the table for rapid growth for the company.
Yeah, I guess so Mark's right. I mean, that the CVCA standard is for the company to have a right of first refusal, and then you go on to the secondaries. Thinking about it from other companies that I've worked with, there is some advantage to having the company be able to exercise that right of first refusal, in that, assuming it has the cash available, which is, kind of Mike's point, if it does have the cash available, it can repurchase those shares, and ultimately, when a share is repurchased by the company, it is canceled, which means that there is some undilution. I'm not sure what the term for that would be, but across the board, everybody who's invested in the company gets a little bit of a bump because those shares no longer exist. The other advantage in the company potentially having the right to exercise that right of first refusal is that where I have seen that exercised would again be the case of an employee shareholder who holds shares in the company. They leave, perhaps on bad terms. This allows you to essentially go out, buy back their shares, cancel them, without having to go through the extra steps and processes that might be involved in issuing a right of first refusal notice to all of the other investors. So those are two arguments in favor of the standard that I can think of. But again, because we're dealing with early stage companies, I think Mike's point is really strong, that using that cash, if you've got an investor who's standing in the wings that wants to buy more of your company, being able to give them the first right of refusal over those shares that are being sold, assuming that they're able to act quickly, I think that's better than using company cash that you need for other purposes. But
as the conversation is becoming more and more technical, I'm realizing that we have to let our entrepreneurs know that they definitely need to consult their counsel, because these issues are now too technical. But I mean, the purpose of this episode was just to give a high level overview of some of these terms, some of the lingo that goes into the legality of the term sheet, so that entrepreneurs are more educated when they engage with various venture capital firms. So I would like to thank Mark, James, and Mike for your time, and really appreciate you sharing your knowledge and wisdom of many years.
Thank you all. Bye.
Thank you all.
Bye.
Cheers.
Thank you very much.
Bye.